Hello everyone, welcome back to the channel. So in today's episode, I'll be going into Microsoft as well as Meta stock. So both stocks reported their earnings and they went in opposite directions. So Microsoft was down around 10% post its earnings report. Meta was up around 10%, and I'll be covering these two stocks here. So the first stock that I'll be covering is actually Microsoft. So Microsoft dropped around 10% after its earnings report, marking one of the sharpest drops in recent history for the company. The last time the company dropped this much was actually during the COVID-19 crisis. And if you look at the earnings report, it was quite good all around. So revenue was up 17%, operating income was up around 21%, net income, GAAP, was up 60%, non-GAAP was up around 23%. Diluted EPS was up 60%, but do take note that this was actually from their non-cash gain on their OpenAI investment. So the non-GAAP number is probably the better one to look at, which is up around 24%. Still quite strong growth. So the stock fell yesterday because of two different reasons. First one is Azure missing growth estimates. Second of all is that OpenAI is currently now 45% of the total remaining performance obligation or backlog of the company, which is at around $625 billion. So I'll address the first point. The first point is on Azure. So Azure missed estimates of 40% by your analyst. So this was what Satya actually said in response to the miss in terms of the 40% target. So he said that, and a way to think about it, because I think I get asked this question sometimes, is if I had taken the GPUs that just came online in Q1 and Q2 in terms of GPU and allocated them to Azure, all of them to Azure, the KPI would have easily been above 40%. And I think the most important thing here is to realize that it is about investing in all layers of the stack that will benefit the customers. And I think that's hopefully helpful in terms of thinking about capital growth. It shows in every piece. So what he's saying over here is that Microsoft is spreading out the capex into all the different business segments, including Copilot, which is sort of separate from Azure as well as the Microsoft 365 suite. So they mentioned as well that if all the GPUs were deployed into Azure, the growth would have been 40%. So in my opinion, this is just wise capital allocation and the market overreacting to such a small miss in the growth numbers. The second one is the OpenAI RPO affiliations. So this was actually released in their earnings call. This was what they said. They said approximately 45% of our commercial RPO balance is from OpenAI. So this got investors freaking out. And in the same segment, they actually said that the significant remaining balance grew 28% and reflects ongoing broad customer demand across the portfolio. So the management revealed for the first time that a significant portion of their remaining performance obligations is actually from OpenAI. So the markets are freaking out because Microsoft funds OpenAI and OpenAI is funneling back the money into Microsoft. That's one concern. The second concern is simply the fact that OpenAI is currently losing the AI race, and with the company still burning billions of dollars, these RPO guarantees are still a big question mark. So the markets are becoming increasingly cautious of the circular loop, as I mentioned earlier, whereby Microsoft funds OpenAI and OpenAI returns the cash through Azure, inflating revenue and leading to poor quality earnings. My pushback is this: the CFO said in the same line that around 55% of the RPO grew by 28%. This is the number that supports the continued revenue growth of Azure, assuming OpenAI fails to pay for that 45% of RPO. And while this may be seen as risky, do note that their RPO for full year 2025 was already at $375 billion. And $268 billion of that was actually coming in from different companies outside of OpenAI. OpenAI was at $107 billion. So I think the recent jump is largely due to OpenAI, and I wouldn't be worried because the other 55% is actually allocated to companies outside of OpenAI. And it's still growing quite strong. It's a 28% growth number. So Azure going forward will track this number quite closely. This is the number to look out for. And overall, I think it was a great earnings report. So in terms of how I view the stock, I think the current sell-off is an overreaction and an opportunity to add into a quality business. And if you look at Microsoft valuation over the past 10 years, this is their median PE multiple. It's around 33 times. It's currently trading at 27 times. And if you remove the OpenAI non-operating income gain, the stock is currently trading at around 28 times. This is historically on the cheap side with bottoms around 25 times here and 25 times here. So on growth drivers, there are a few different growth drivers to look out for in terms of Microsoft's revenue. First of all is that we will see continued price hikes going into 2026. So they announced price hikes of between 5 to 33% across the entire Frontier plans, and Microsoft has been exercising strong pricing power over the recent years, since around 2024. And as you can see over here, the ARPU growth, which is basically the pricing growth, has gone up by 9% for 2 years in a row already. And in this year as well, we can expect something that is similar to this, with continued seat gains as well, which I'll explain later on. So ARPU growth has been around 9% over the past 2 years, with projected further price increases this year. Second of all is that you will see tailwind effects in terms of seat growth for Microsoft 365 because the on-premise people are actually swapping over to the subscription business. So Microsoft has 2 different business segments for their traditional suite of products. You have Microsoft Office on-premise, which is on-site and transactional, and you have the 365 commercial, which is recurring revenues for the firm. So continued transition of users from on-premise to their 365 commercial that is recurring revenue will help to increase the lifetime value of the subscribers, increasing long-term business quality. And besides that, it also helps them gain the ability to upsell existing subscribers and increase the bundling and the deals that the customers can sign. So for example, Teams was integrated and the prices were hiked. Same thing here with Copilot. This is what the company is doing today. Third of all is that cloud growth is still strong, tracking the RPO number. So excluding OpenAI, RPO is still currently growing at around 28%. And historical RPO numbers has grown at between 20 and 25%. So we're seeing some form of an acceleration here. This is a key indicator that Azure is going to see continued revenue growth. Second of all is that Azure's growth can be tracked using your capex growth. So because Azure is currently capacity constrained, what this means is that the increase in capex will likely be to fulfill Azure's demand. So with increased capex, this likely supports the claim, or this likely supports the view that Azure will continue growing at a relatively fast rate. So in terms of revenue growth for the firm, I'm projecting between 12 and 13% growth for the next few years, excluding this year, which is around 18% because of the price increases. So revenue growth is still going to be strong over the next 5 years, and revenue growth of between 12 and 15% will likely translate to equal amounts of EPS growth for the firm, and at 28 times, Microsoft is attractive today for quality business. So I've added into Microsoft, significantly increasing my position after their earnings tumble. I'll likely continue adding if the stock continually falls. The next stock that I'll be covering is Meta. So Meta reported quite incredible numbers. So revenue growth was at 24%. The cost was up 40%, attributed to their personnel as well as the stock-based comp expenses and increased in depreciation as well as amortization. And besides that, they also forecasted that the capex will be between $115 billion and $135 billion, which is quite incredible. So while I believe that Meta's capex is getting out of hand, a key thing to understand here is what exactly they're spending their money on. So it's a bit different from the other hyperscalers. So for Meta, in terms of the capex, they're spending their money on 2 different portions. First one is this Advantage Plus. It's an ad suite to improve advertisers' return on ad spend, to reduce their cost per acquisition, and to increase stickiness and lower the barriers to entry by providing them with the ability to generate ads on Meta's existing platform. So Meta is pouring money into GPUs for Llama to generate AI advertisements and for machine learning to have better recommendations as well. Second of all is that they're spending this money to increase retention rates and engagement numbers by providing better recommendations. Same thing through machine learning. And in the recent earnings call, this was what Meta said. They said that the Instagram Reels had a very strong year with watch times up 30% year on year in the US. Engagement is benefiting from several optimizations we made to improve the quality of recommendations, which is based on the AI spend, of course. Second of all is that on Facebook, video time continued to grow double-digit year on year in the US, and we're seeing strong results from our ranking and product efforts on both feed and video surfaces. So I think overall Meta is doing well in terms of their capex spend, but I would take note of their capex and take note of the indicators that they have overbuilt. So normally when a company has overbuilt infrastructure and capacity, what happens is they will start selling APIs so that they can make sure that those capacity is still used during downtime. And it is normally a signal of overbuilding if the company hasn't historically sold their APIs. So in the case of Meta, they're currently not doing so yet. And this was what Zuck actually said about APIs as well. So he said that, so I think this is a really fundamental thing, where my guess is that frontier AI, for many reasons, frontier AI meaning the leading AI models, for some reason, are not going to be always available through an API to everyone. So Zuck hinted here indirectly that APIs will be restricted. This is a positive. And although it does not directly address the idea of overcapacity, but this was all I gathered from their earnings report. So yeah, this is for the API portion. As for the growth for the firm, I think there are many different untapped revenue streams for Meta. So first of all is WhatsApp as well as Threads. So WhatsApp and Threads are two apps that have not been actively monetized yet. Meta has a history of doing this. So they managed to bring Reel from a $10 billion run rate in 2023 to $50 billion run rate in 2025. So they 5x in a matter of 2 years. In the case of WhatsApp, the average revenue per user is still relatively low, excluding integrations with Facebook as well as Instagram. So if you were to compare WhatsApp with, let's say, Telegram, Telegram actually has a higher ARPU because they have subscription, they have ads on their app itself. WhatsApp is still relatively unmonetized. It is similar with Threads. Threads just introduced ads on 21st of January. So this could be a tailwind for the company as well. Second of all is that we could see continued strength of their family of apps ad revenue. So family of apps is still relatively strong, signaling strong ROI on the capex spend that the company has done. In the case of valuation for Meta, the current GAAP P ratio is at around 30 times, but do note that they had a one-time expense in Q3 of last year. So without a one-time expense, the company is trading at 24 times of earnings, slightly below the median over the past 5 years. Capex spend now is basically draining the entire free cash flow for the firm. So as an investor, you're basically getting zero free cash flow yield from Meta today. Revenue growth must be in line with their capex growth. If not, there will be a bottom line that will fall off a cliff. And for Meta, it's a fairly valued company. I'm still holding on to it. I hope you guys have found this video useful, and I'll see you guys soon.